Good morning, everybody. Hey, welcome to Wednesday, May 26th. It's just so hard for me to believe that this month is about over. Memorial Day is coming up this weekend. And I hope that you are going to find some time to spend with family and friends as it's been a while since we felt comfortable doing those type of things. But hey, before we do that, remember, we're going to talk to Dave here in just a second. I want to remind you there's several ways we can connect. Our website, statlerfinancial.com, Facebook, you can look for us there under Statler Financial Services. We would love for you to connect with us on the radio. Every day you can find us somewhere. And so we're excited about all those things going on. But more important than that, remember, there's only one thing that any of us can really control within our portfolio. And with all the volatility we're seeing, it's becoming even more important. And that's how much risk you have in your portfolio. And so I believe that it's important that everybody know what that risk number is for them. And to do that, we've established our financial x-ray, a great opportunity to find out how much risk you have in your portfolio, how much you're paying in expenses and fees that you don't really see, and those type of things. So give us a call at 863-382-0037. Yes, 863-382-0037. A great opportunity to find out where you are. And so we're looking forward to that. And Dave, what's next, buddy?
105.7 Light FM. It's Taylor Swift there. Hi, I'm Dave. It's 8:40 now. 20 before 9. Time to check in on your money and see how your retirement accounts are doing. Checking in through the resources of Statler Financial Services' very own Phillip Statler, who's on the phone this morning. Phillip, how are you today?
Good morning, Dave. Hey, doing well today. It's just hard for me to believe that this month's basically over.
Yeah, pretty much is already. I mean, we had 2 more trading days after today, and then we enter a 3-day weekend, and we start thinking about June. One thing's for sure, the old sell in May and go away stuff doesn't seem to be happening because we've got people out there talking about indications of a bubble in the market, which is kind of strange, isn't it?
It is. I mean, you and I kind of been thinking, how much further can it go? But this analyst from Allianz Securities over in Germany, basically, I found it interesting. He said, when we look at price to earnings ratio, which is one of the things that we gauge how high, the market is relative to what we believe it should be. And the price to earnings ratio on the S&P 500 says like 37. The NASDAQ was like 55. Those are some pretty high numbers when we look at price to earnings ratio. But he continued to say, don't get out too early. There's still room for this bubble to keep getting bigger. Yeah. So he's like, let's write. He said, we are cautiously looking at the bubble, and he believes that the impetus that will cause it to bust is going to be the central bank, the Fed, finally doing what they've been saying they, quote, are going to do that they haven't really done yet, and that's start tapering their bond buying and raising interest rates. So he said, when that happens, look for this bubble to burst.
And that was something that gave everybody the willies earlier this week when one of the governors of the Federal Reserve said, maybe it's time we started tapering that bond stuff back, and the market kind of got the willies, which kind of adds credence to that. Yeah, talk about price-earnings ratios. I hadn't looked at it at the end of this earnings season yet, but I do recall that flash crash we had back in, what was it, 1970 or 1987? 87.
Yeah,
87, yeah. Yeah, the indications were on that one that a whole bunch of computer sell orders got triggered when, get this, the S&P price-to-earnings ratio went over 20. And now we're looking at 37. You think we might be a little optimistic in terms of stock values at the moment?
We continue. They had a criteria checklist here for bubbles, and one of them was overvaluation in multiple asset classes and hopes of a new era. And the new era for us is AI, right? Artificial intelligence.
Yep.
So, yeah.
It's going to be interesting. Once again, this is a measurement of optimism for future earnings, But at the same time, if those future earnings don't get delivered, this could be a rather rough rest of the year if the next quarter's earnings reports don't show the kind of recovery that we're all hoping for. Which kind of leads me into something. My tidbit for the morning was there's a new index out to watch. The folks from Moody's, with a little cooperation from, of all credible sources, CNN, they have a business recovery index from the COVID pandemic. And I found it kind of interesting, state by state. We got a few states that are actually back to fully recovered. They include Florida, West Virginia, Oklahoma, South Dakota, and Idaho. The rest of the nation is not fully recovered yet. And some of them are way down 60 to 69% recovered. Shouldn't surprise you very much. Lead among those are California and New York.
Yeah, well, that I could have told you that before you told me the numbers. See, that's they're way behind us for sure, and that's an interesting index, and it'll be interesting to see if they update it and how often they update it and what it looks like, and when do we get the whole United States fully recovered.
Yeah, it's kind of interesting to watch. I was kind of surprised, and pleasantly so, to find Florida on the list of the quote-unquote fully recovered states. Of course, with all the help wanted signs we're seeing out right now, that isn't a major bulletin of a surprise to any of us, is it?
No, it's really not a big deal at all. So, we talked yesterday before we got off the air, Dave, about not much in the way of macro stuff. And what was coming out after we got off the radio. And we did have two numbers, and I think that probably maybe caused some of the decline yesterday midday. And one of them was new home sales.
Yes.
It missed substantially by almost 100,000. And so that was, I think, a big deal. And then consumer confidence was a miss. And it wasn't near the miss that the new home sales was. But anytime we start to see consumer confidence miss to the downside, that's not a good sign.
Yeah, it certainly isn't, especially when consumer confidence is what we're hoping for to redrive the economies back open again. Like you mentioned, we started out in a halfway decent mode yesterday. At the end of the day, though, the Dow was off by 81. 81. I was reading my screen properly. S&P down by about 9. NASDAQ down by 4, which isn't a major loser of a day, but still, it's red ink, and we were kind of expecting better based upon the morning indications, weren't we?
Oh, definitely. And it stayed green probably till lunchtime, maybe a little after lunchtime before it started to really fall off of those highs that we saw for the day.
Yep. So we're going to cross our fingers we can regroup and do it again this morning. And so far, at the very least, it looks like we're taking back some of what we gave yesterday. Any of the market reports from the publicly traded stocks going to back that growth up this morning?
It's funny that I look at this, and we've got two retailers that are just killing it when it comes to the numbers: Dick's Sporting Goods and Urban Outfitters. Both of them had a really good quarter. I mean, Dick's Sporting Goods, their earnings per share were more than triple expectations. They came in at $3.41 compared to $1.12 that was expected. Revenue beat. Same-store sales were more than doubled what they expected. And of course, they really hit the trifecta here, Dave. They also gave full year guidance that exceeded the expectations of Wall Street. So that they are a big winner today, up 8.3% this morning.
Crud. Well, once again, expectations count for a lot, especially given the multiples everybody's going at, right?
That's right. And then Urban Outfitters right there with them. They more than tripled their earnings per share. They were expected at 17. They came in at 54. Revenue beat. Same-store sales were up 51% compared to a year ago.
Whoa.
Yeah, more people are out shopping because they're getting vaccinated, and they're up even better than Dick's Sporting Goods. They're up 11% this morning.
Wow.
Yeah.
We're getting some good news out of a bunch of stocks this morning.
We are, but I got some bad news on the retail front too, Dave.
Well, poof, what you got?
Nordstrom's. They lost almost 50% more than expected. Or I guess I should say more than almost double what was expected, because they were expected to lose 57 cents a share and they lost $1.05. So not good there. Their revenue did beat expectations, but they had some issues because they had all that Christmas stuff, holiday inventory and nobody was really shopping. And so they had to get rid of it. So they had a lot of markdowns in the quarter, which is putting some pressure on their stock today, down almost 6% this morning.
I kind of stereotype them as being very, very dependent on brick and mortar stores, too. I don't hear as much about them on the internet.
Well, that's true. That's true. And this seems to be the reporting time for a lot of retail and clothing stuff, because I have Capri Holdings, which reminds you is Michael Kors, Jimmy Choo, Versace. It's that brand, those brands of clothing, and they beat by 2 cents a share. Revenue was better than expected, and they issued better than expected full year guidance as well. So they're up about 2.3%. And
wow.
Another big name, Abercrombie and Fitch.
I saw they had a beat, didn't they?
They did. They beat by double what was expected. They came in at 67 cents a share compared to 38-cent expectations. I'm sorry, that was supposed to be a 38-cent loss, and they made 67 cents. So yeah, that's a big swing for them. So they're rallying big time today, up 6%.
Now we've got nothing, basically very little but good news on the reports this morning so far.
For the most part, you are absolutely right. Let's look at builders. We got Toll Brothers came in. They beat by 21 cents a share. Revenue was better than projected. I'll get the word out there. Mortgage rates still low are obviously helping home builders a lot. They are having issues though because of supply chain. You know, wood cost has gone up crazy and type things like that, but not hurting their stock price this morning, up 2.5%.
Cool. I got one more.
I do actually. That it is the only one I have left, and that's Intuit. Intuit reported, and they missed by about 40 cents a share. They came in at $6.07 a share compared to $6.47. Revenue was missed, shy of what everybody expected, but they did raise their full year forecast. So good there for them. And they were trading down, but they have made the flip up. They are up 2% right now.
Okay, having QuickBooks fall on hard times is kind of a surprise, isn't it?
Yeah, it is, because everybody's got to have it anymore. Small businesses, you can't hardly operate without it.
It's rapidly becoming the standard, that's for sure. Resetting the table, a slight off day yesterday off of disappointing national reports. 45 minutes before we opened this morning, are we going to take back what we lost yesterday, Phillips?
Well, we're going to get some of it back, if not all of it back. We got the Dow up about 0.25% right now, about $77. We got the S&P 5 up about 1/3, and the NASDAQ's up about 1/3%. Small caps making the biggest run today. The Russell 2000 up almost 0.5% this morning. So good news on the index front. Now, if we can just keep it holding all day, that may be the key. Commodity side, we've got silver and gold both up. Silver's up 0.6, gold's up 0.5, and then crude oil is about where it was yesterday, but that's down 1% from where it closed last night. So it's at $65.41 a barrel.
I think you've been filling up your SUV again there.
Yeah. No, that's I'm waiting for it to drop below 65.
I gotcha. World markets, Asian rim markets, generally up, not monstrously, but by 0.33% or so early this morning at the close. Europe is mixed with absolutely zero trend. Germany is flat. Great Britain is off by a little bit, and France just swung ever so positive midway through their day. Philip, we were talking about the potential for a bubble. But the one place you don't want to live on a bubble is when you're getting close to retirement, and that means controlling risk. How do I find you to control that risk in my retirement fund?
David, give us a call at 863-382-0037. They can check out our website at statlerfinancial.com, and they can join us this weekend. I know it's a holiday, but you can still listen in on the radio show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk, 730.
A couple more weekdays of us, too, tomorrow morning, same time here on Light. Philip, thank you so much, and we'll see you then, all right?
All right, man. You have a great day. Folks, we really appreciate you joining us today. I hope that your week continues to go well. I look forward to you joining us again tomorrow morning, same time, same place. Check us out on Facebook. Until then, have a great day. Bye now.